As you guys know, Disney has long been one of my largest stocks in my entire portfolio for many years, and it's still currently my third largest stock at this time. Well, they recently reported fiscal 2019 earnings, and they also just now released Disney Plus. Like at the time of this recording, they just released it a little while ago. And as a shareholder, of course, I had to sign up. And I gotta tell you guys, I am loving Disney Plus, and I think it has huge potential. So with all of that in mind, a lot of you have been asking me to share my thoughts on those different things and where I see the stock headed in the future. So that's what we're gonna talk about in today's video. I hope you guys enjoy this. Let's go ahead and get started. What's up everyone, my name is Olive. Welcome back to my world of stocks. All right, let's just go ahead and jump right into this and let's take a look at the stock, and then we'll transition into their business performance as well as their most recent earnings. And I'll also touch on a few different extra details that they gave during their earnings call. And then we'll finish up with my thoughts on Disney Plus and how much potential I think they have with that going into the future and where I see the stock headed. Okay, so in the past 5 years, the stock is up over 50%, but it's really been stuck in a range of right around $100 a share. And for years now, I've been buying anywhere below that and just a little bit above as well. But fast forward to this year though, and the stock has finally shot up by almost 25% in 2019, which is what I've been waiting for myself. Unfortunately though, if you still have not bought into Disney at this point, then you're going to have to pay a premium for it, as their forward PE ratio is 8% higher than the sector median. Still, in my opinion, an 8% premium actually looks like a bargain to me for a company like Disney that is obviously so much better than most other companies out there and also carries an incredibly strong and very popular brand. On the other hand though, their investments into streaming are weighing very heavily on their profits, and thus their PEG ratio is over 100% more expensive than the sector median, although PEG ratios are not always taken 100% seriously because it's so difficult to predict around 5 years or so into the future. But ultimately, those investments are likely to pay off in the form of incredible revenue growth that Disney is not really used to seeing. In fact, they only grew by 6% in 2016 and actually dropped by 1% in 2017 before seeing some higher growth of 8% in 2018 that accelerated to 17% growth this past fiscal year, and that's expected to continue growing by another 17% the year after, topping $80 billion in a single year. That is a lot of money. Again, these investments will be taking a serious toll on their profits as their EPS dropped heavily this past year, which we'll take a look at in just a second when we look at their earnings, but it's also expected to drop by another 4% this new fiscal year that we just entered before returning to growth the year after. But that's ultimately the price that you have to pay until these new services become profitable and they learn how to cut costs after making a gigantic purchase of 21st Century Fox assets that sent costs all around rising. As far as when that'll be, well, what we know is that they're projecting profitability for their new ESPN streaming service called ESPN Plus that launched just last year to happen sometime in 2023, but will currently still be costing them well over $500 million in losses until that happens, as they continue to grow their subscriber count that reached over 2 million subs within the first year to around 10 million subs by 2024, which would obviously be very high growth. By the way, during this latest earnings call, they announced that ESPN Plus has already topped 3.5 million subs as of today. So it's clearly growing at a very fast rate thanks to new partnerships like the one that they just made with the UFC that recently gave the platform one of its largest live audiences to date during a recent UFC event. They're also aiming to double their sub count on Hulu to around 50 million subs by that same year and reach profitability around the same time as well. Currently though, Hulu is costing them a massive $1.5 billion, but during the earnings call, they noted that they've added another 3.5 million paid subs in just a matter of months and will aim to keep this growth accelerating in the future by bringing over assets from the Fox acquisition into Hulu. For example, in March, they're bringing over everything from FX, which since 2014 has won over 150 Emmys. And FX will bring over 40 different series and continue to create original programs exclusively for FX on Hulu, with 4 new ones next year alone. And finally, Disney Plus is targeting profitability around the same time, but will still cost them around $1 billion in losses until then. But we'll talk more about Disney Plus in just a second. But I'm sure you guys are starting to see the picture here, and that's that Disney is going all in on video streaming. And in my opinion, it's absolutely the right thing to do, because cable TV is a dying kind of business right now, and you don't really want to be investing in that legacy type of business that isn't really going to go anywhere. If you're someone like Disney, who has all of these amazingly strong brands and IP from both the past and the present, and also heading into the future, then you need to strike while the iron is hot. Get into the market now, spend as much money as you need to become a market leader, or at least a very top contender. And don't wait for other competition to realize their mistakes and flood into the market. Get ahead of them, spend as much money as you need to, invest heavily in it now. I'm really happy that they released this streaming service so early here in 2019, while other companies are still kind of lagging a little bit behind, as we'll take a look at in just a second. But if you're Disney, invest as much money as you need to now to really get ahead. And if Wall Street and analysts are focused on all of this profitability, just report the high revenue growth, report the high subscriber counts, and I think that can kind of help sustain the stock for now until you really start to collect the fruits of your labor later on down the road, and you start to realize high profitability a few years from now. But how are things going right now? Well, let's take a look at their fiscal 2019 earnings, and let's also talk a little bit about Disney Plus and why I think it's so important for the future of the stock and where I think all of that is headed. Now, as I mentioned before, these earnings were pretty strong, as they essentially beat estimates on both the top and bottom line, which sent the stock climbing by over 5% at one point. Adjusted EPS came in at $1.07 versus 95 cents expected, while revenue was also higher than expected by about $60 million, coming in at over $19 billion in just a single quarter alone. Year over year, that was a huge increase of 34% for the quarter and 17% for the year, driven heavily by their massive studio entertainment segment that continues to release huge blockbuster movies like Avengers Endgame, which, by the way, set a world record for highest grossing film of all time this year. And I don't want to go through this entire list because it is pretty long, but even if you just look at like the top portion here, you can see that most of the highest grossing movies of all time are usually made by Disney. And in this latest quarter, that studio segment grew by over 50% year over year, doing over $6.6 billion, again, in just a single quarter alone. Of course, you have to look at the full year to get a better idea, since release dates play a major role, but even then it still grew by a double-digit percentage, while media followed suit, and the new direct-to-consumer segment grew by close to 3 times the amount, and that's without Disney Plus having even launched yet. Still, if we go back to those original earnings, you can see that profits are really tanking hard, as adjusted EPS dropped by 28% for the quarter and almost 20% for the year, while GAAP figures dropped by even more, not to mention that free cash flow completely plummeted. Of course, you might be asking why, and so I'll just quickly show you a few different screenshots here that explain why certain parts of their business are losing hundreds of millions of dollars each, but the gist of it is what I've been saying all along, which is that there's going to be huge costs and charges associated with the Fox acquisition, the transition to direct to consumer, and continued losses from their legacy business in cable and TV that they're still trying desperately to offset and transition a little bit away from. Shoot, they've even mentioned that they're paying more interest on debt because Fox had so much of it on their balance sheets that came over with them during the acquisition. Still, the main story for Disney is that they're a transitioning company right now, so where do I think they're headed in the future? Well, during the conference call, Disney CEO Bob Iger mentioned that he's not really worried about the tsunami of competition that is flooding the video streaming market, like Apple TV Plus or HBO Max, on top of platforms that have already been dominating the market like Amazon Prime Video, and of course the market leader in Netflix. And the reason why he's not panicking is the same reason why I'm not worried myself. Disney just has the strongest media brands in the world, and there's really no one that even comes close. I'm not trying to be mean to Netflix, but in my opinion, their original content is not even in the same universe as Disney's. And no matter how much cash they burn through to try to catch up to Disney, I don't know that they will ever be able to, since Disney is clearly dedicated to investing just as heavily into not just creating new brands, but also strengthening their already massively dominant ones as well. You've already got Marvel with all of their movies and shows and new exclusive shows coming to Disney Plus soon, while Star Wars continues to be just as large with all of their movies and shows as well, which by the way, The Mandalorian is looking like super dope, and I think it's going to be extremely popular, possibly even getting close to something like Game of Thrones. And they're also working on an Obi-Wan Kenobi show that I think is hugely underestimated in my opinion and will likely be just as big, if not bigger. And of course, they can easily do multiple seasons of each to keep fueling the service in the future. But you also can't forget about all of the amazing family content from Pixar like Toy Story, Monsters, and Finding Nemo, and all of the other new and classic Disney IPs that they own like The Lion King, Aladdin, and Frozen, and even then you still have bonus content from Fox like Avatar and The Simpsons. And you get all of this content, including National Geographic, by the way, which is a market-leading brand in their own right, for around half the price of Netflix on Disney Plus. And any leftover content from Fox will go straight into fueling the Hulu platform as well. At the time of this recording, Netflix charges $12.99 for their standard membership that limits you to only 2 users streaming at the same time. By comparison, the same price with Disney gets you Disney Plus, an ad-supported version of Hulu, which, by the way, will bring in even more digital ad revenue for them, which we know is a hugely growing market as well as more businesses continue to advertise through digital kind of means. But you also get ESPN Plus to go right along with the other two. And if you're only interested in Disney Plus, you can opt for just going with that option alone for close to half the price of Netflix. In fact, if you get the year deal for $70, that actually comes to $5.83 per month, which is actually less than half the price of Netflix. And by the way, this is kind of anecdotal, but I know like a lot of my friends and family are opting for that yearly deal because it is a little cheaper. And that's actually a great way of keeping your subscriber base from just kind of jumping ship. Because I know a lot of people, including myself, just sign up for Netflix and kind of watch everything and then cancel the membership. And then they'll go to another service and watch some stuff and then cancel. But with Disney, if you get the whole year pass, then you can't really cancel just kind of midway through. But anyway, by the way, you also get, with all of this, you get double the amount of users streaming at the same time at 4 on Disney Plus versus only 2 streaming profiles on Netflix. So in my opinion, the value is incredibly attractive, and I think over the longer term, Disney Plus actually has a real shot of surpassing Netflix's subscriber count. Now, that might, it could definitely take a while until that happens, but I think they do have a shot, and that would be a huge deal for 2 primary reasons. Number one is that the market is enormous at a projected value of close to $25 billion this year alone. And that should only get bigger and bigger in the future as more people continue to cut the cord. So if Disney can become a market leader through one or perhaps several different services, that would be huge. And number two is that Netflix is essentially a one-trick pony, only really competing in this single market, yet their market cap for the stock is more than half of Disney's, despite Disney being so much massively larger as a company and much more diversified. In fact, in the past 12 months, Disney brought in more than 3 times the revenue of Netflix and almost 9 times the net income, according to Yahoo Finance. And that's all with Disney's direct-to-consumer segments making up by far the smallest amount of their sales at less than 14%. Yet Netflix has a forward PE ratio that is more than double that of Disney's. Now, this isn't meant to be a fight between the two stocks, but I'm just saying that with all of the potential that Disney has in their direct-to-consumer business, yet they're still diversified into other areas as well, you would think that the market would value Disney higher like it does to other stocks like Netflix that in my opinion are not as good of a stock as Disney. Don't forget that Disney is also a very attractive dividend growth stock with a decade of consecutive growth, a high growth rate of almost 15%, a low payout ratio of less than 33%, and a yield of about 1.3% as well, even after the stock has climbed by so much this year. Of course, to be fair, that payout ratio is likely going to skyrocket because of how much Disney is investing in their business right now, but I would expect it to return to normal levels again a few years from now. And by the way, just to add another thing about Disney Plus, something that they also mentioned in the conference call or in the earnings call is that they've been testing the service in multiple areas and they're seeing strong demand from all demographics, including men, women, adults, and children. And ultimately, that's another big deal that I think doesn't get enough attention. Disney Plus has something for everyone. If you're looking for action and adventure, you get it with Star Wars and Marvel. If you're looking for science, you get it with National Geographic. And if you're looking for family-friendly content and stuff that your kids will love as well, you get it with practically everything else on the platform. But it's not just the type of contents that you get with Disney Plus, it's the fact that you get the highest quality of that type of content, because Disney spends the highest budgets out of practically anyone to ensure that they release the best possible versions of their offerings. And because they've been doing it for so long and have built up such an amazing backlog, it's very difficult for Netflix and all of these other companies to really compete with them, in my opinion. And even then, you're still only paying about half the price of something like Netflix. So the value proposition for what you pay is just way too attractive to ignore. And this is absolutely anecdotal, but the service just launched like a couple hours ago, and I immediately started receiving text messages from friends and family that are extremely eager and excited to start watching all of the content on Disney Plus. So I really think that it's going to be something really big. But as far as the stock goes, well, it's difficult to say how Wall Street will react to it, because if they focus more on the dropping profitability, then it could struggle a bit. But if they focus more on the high revenue growth and especially the high subscriber growth, that will be very important in the future. If you have a huge subscriber base that you can monetize, that you can sell to, that's a really big deal. And Wall Street really likes those kind of numbers. So it kind of just depends on what Wall Street will focus on. But for me personally, and for some reason people always hate it when I say this, but because it's already my third largest stock, it just doesn't really make sense for me to be adding to my position at this time, given that the stock has already climbed a lot. Now, if Wall Street was to focus more on the dropping profitability and the stock was to take a bigger dip, then sure, I would absolutely consider adding to my position, even though I'm already up a lot. Like, my cost basis is still under $100. So I am up a lot on my position, but I would consider actually adding if there was a bigger dip, or even if the just kind of the overall market had a little bit of a pullback, because I actually think that we're overdue for a healthy correction. And if that was to happen, you know, stocks like Disney, Microsoft, Amazon, those are the stocks that I love to buy on any kind of market correction or pullback, because they're amazing companies. So if outside factors are dragging them down, I love to pick up those stocks at those lower prices. And at the end of the day, this is absolutely a very long-term stock for me that I could easily envision myself holding until like I retire or something. So I definitely wouldn't mind picking up more shares, assuming that management doesn't screw everything up. But if the business kind of keeps going the way that I think it will, then this is a stock that I really believe in over the very long term. So anyway, that's kind of just how I feel. What do you guys think? Let me know down below. Do any of you own Disney stock? Are you buying, holding, or selling? I'd love to hear your thoughts, no matter what kind of position you hold. Anyway, I think that does it for the video. If you enjoyed the video, make sure you hit the like button. It really helps support the channel. It means a lot to me. Thanks again for watching. I'll catch you guys in the next one. Take care. Bye-bye.